Hi everyone, it's Alex here at Cestrian Capital Research. Welcome to our weekly webinar. It's currently Thursday the 7th of March, 4:15 Eastern for the benefit of the tape. Okay, so today I want to run through our usual index review. So that's the S&P, the NASDAQ, the Dow, the Russell. And then we have a series of earnings to run through that have been printed since our last webinar. And so they are Zscaler, ZS, Snowflake, SNOW, Autodesk, IRDM, IRDM, CrowdStrike, CRWD, and Spire Global, SPIR. As always, we'll do live Q&A. And as we've been doing recently, I propose to run through each section and then pause for questions after that. So for now, folks, mics are on mute, but we'll unmute them in due course. If you can use audio, great. Shout any questions or comments you might have once mics are open. If not, then you can use the question function here in the webinar platform, or the chat function in the webinar platform, or if you are a Growth Investor Pro subscriber on Seeking Alpha and you have access to the chat room there, then you can always post questions in the chat room. Okay, before we do any of that, let's take a look at our disclaimer, and let's just run through that for you. That's on your screen right now. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in this webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Cestrian Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Cestrian Capital Research. Cestrian Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so let's do index review. Let's get those charts on our screen right now. Okay, so here we have the S&P in SPY form. I mean, there isn't a lot to say, right? We just keep saying the same thing every week, which is SPY is on an unbelievable bull run. And anyone who doesn't think this is a bull market, I don't know what they're thinking. So it could turn tomorrow, but why you wouldn't think this is a bull market so far, I have no idea. Here's the October 22 low, 346. We get a huge run up to the middle of 2023, a modest sell-off into the end of 23, and then a just unstoppable bull move on the way up now. I mean, this bull move now is as strong as we saw coming out of the COVID crisis. It has all that feel of just, unstoppable force. So our base case, again, just to run through this, 533 on the SPY, lower end of the base case, 583 upper end. And, in all honesty, I would be surprised if it stopped there. It may do, we'll see. Every Elliott wave theorist you'll see, will be casting that base case from the 2018 lows, and will be calling for a bear market starting pretty soon between 530 and 580. And we'll see, that could happen. That's not now, it's not today, could be tomorrow. More likely if it's going to roll over in this zone, that's a few weeks out. But my best guess is it's going to power through that. So for me, that's a case of do nothing and watch price, react to price, don't anticipate. So we shall see. But for now, looking pretty bullish. Here's the short-term chart, the ES futures. Key level to look at, I think, is the 52.75 level. That would be the 3.618 extension of this wave 3. This is a 5-wave cycle that began in the December 22 period. So 1 up here, a 2 down. It's blasted through the 1.618 extension, blasted through 2.618, didn't even look back, retested it a couple of times. And it's heading up to this 3.618. So we'll see. But again, just a dramatically bullish move. Let's look at the NASDAQ. Here's the QQQ. It's pretty interesting, really. I mean, QQQ, look, this is, focus on this red box here, right? So this is if we are in our base case of a 5-wave cycle that started in the 2018 lows, then the QQQ should be selling off somewhere between 405 and 446. Well, look, this is the evidence that says maybe it's the base case and maybe we're going to get a market dump soon. 2 data points, right? Which is last week, it couldn't break that 446 level. And this week, so far, it can't break that 446 level. Now that is a relevant technical level, that 0.786 extension wave 5. That's a well-known technical level at which wave 5s can expire. And this isn't just, gumbo that, idiots me like to make up. These are standard institutional trading patterns. And so it's relevant that it has yet to break through 446. If the market's going to roll over in this base case, then it might do so here at QQQ 446, or it could right up to the 100% extension, that's 498, 499, and roll over there. So, be alive to that possibility. Bull markets fail when they run out of buyers. I don't know that we've run out of buyers yet. There's still plenty of people who are in denial, but it could happen. So QQQ is one to be alive to. If it powers through that, then a bull case would be to look to 650 on the QQQ. Not going to happen tomorrow, obviously, may not happen at all, but that would be the place to look. So key levels 446, does it form resistance? Does it power through that and turn that into support? That would be bullish. And if it turns into support, next stop 498, does it find resistance there and sell off, or turn that into support and move up? So, one doesn't need to panic long or panic short. You can just watch price. Major market pivots don't tend to happen in the blink of an eye. They tend to happen when key levels are tested and retested and then either fall away, and in the case of a resistance, the market keeps moving up, or in the case of support, the market keeps moving down. So, does that key level fail or does it hold? So failure of resistance in a bull market means the market keeps going up. Resistance holding means that the market's pivoted. And these tests tend to take place over a number of days, even weeks. So even if you were thinking, well, the market's run away from itself, I'm getting out right now, then it doesn't necessarily pay to make those snap decisions. Sometimes it can be better to just watch the market, and if the level is tested and retested and it won't break, then sure, maybe that's resistance. That's what happened in the 2021 high. We looked at that last week, where it took several days and weeks for the S&P and the NASDAQ each to fail to breach a key resistance level, and they rolled over and sold off. So in short, really very bullish markets in the S&P and the NASDAQ right now, and if these bullish markets are to fail, we'll see it happen. And speaking for myself, I'm not sat here on a hair trigger going, quick, when do I sell? I'm sat here wondering, I wonder when it will roll over. Because obviously it will at some point. And the question is now, tomorrow, next week, when? But I'm reactive, not proactive on this, because price will tell you where prices go. Right, the Dow. I mean, look at that. This is, a major index. I mean, it's just only up. And it's got plenty of room to run yet for any sort of base case resistance to be met. Dow futures, so YM. That's pretty interesting. So I bought UDOW recently, UDOW, a new position in that. And I bought it because we'd had this wave one up here from 37,300 on the YM futures up to 39,350, a sell-off. And it looked like the 38.2% retrace was going to hold. That's a very gentle wave too, but we're in a bull market. So I thought, well, I wonder if that'll hold. And I bought. And so far, it's moved up. And we'll see if that carries on. But zooming out, the Dow continues to look very bullish. Russell's looking good, right? We've said for the longest time, 200, key level on the IWM, which is the unlevered 1 times Russell long ETF. If IWM holds over 200, bullish. Under 200, bearish. And the number of closes over 200, that's a weekly chart. Let's look at the daily. 200 level, let's just sketch it out here. That's 200. So the number of closes over 200, it's really relevant. So look, this is February 27, 28, 29, March 1, 2, 3, 4. I'm sorry, March 1, 4, 5, 6, and 7, all over 200. So that looks pretty good to me. And back to the weekly for a moment. There's plenty of room to run. If you think that the S&P and the Nasdaq and the Dow have all made new highs, but the Russell hasn't, that alone says, if this rally broadens out, there's plenty of room to run in the Russell. So I'm personally long TNA. That's the 3 times long Russell ETF, and on that chart, this is TNA. Then I'm looking for that to break 42, which it hasn't quite yet, and turn that into support. So there's not quite there yet, but I think it may get there. So that's the Russell. So before we move on to indices, why don't we stop and take some questions? So just 1 second while we switch mics on. Hang on. Okay, there we go. So anyone has any questions, shout right now. You can shout on the audio, or you can post questions in chat, whatever suits you best. Anyone has anything on equity indices, or frankly anything else, how about it right now? Okay, no questions. All right, let's move on to
Alex,
Hi,
quick
Preston.
question. So is now I think is now a good time to re-enter TNA like IWM?
You asked me that question last week, Prasad, and I'll give you the
Right.
same answer I gave you last week, which is I can't tell you. You have to work that out. I can give you charts. I can tell you what I'm doing, but you have to work out what you want to do, because only you know what's right for you.
Okay, but right now, last 5 trading days, it's held up strong, right, above the 200 level,
Right. So
right?
so
It's
uh,
showing.
so as you know, we're not managing money here. We're not giving any investment advice. This is an analytics service. So I give you the best analysis that we can prepare, and I disclose all trades that I make personally in the instruments we cover. So that's as much as I can do. And after that, you've got to make your own decisions.
Got it. Got it. Okay, and just one clarification on on your disclosures. Like when you say 1 unit of TNA or 1 unit of whatever stuff that you're buying, right? Like, what does it represent? Like, is it like 1% or just
No,
uh,
it's a standard. It's a fixed amount of capital, and the reason I disclose it in units is because obviously everyone has different account sizes, and if I express it as a unit, particularly with those hedged ETFs, if I say that I am, 2 to 1, if a to 1 long TNA TZA, if that's for instance, I'm not that at the moment. I'm just naked long TNA. Then it helps express uh, the holdings in a way that people can understand in their own accounts if they want to. And the other thing is unit count can show, intensity of opinion, if you like. So, right now by cost, I have something like 25 units long TNA. It's unhedged. Um, so that's the reason to do it. But a unit can be any amount of money. It just in the system that I use, it's a fixed amount of capital, and that means that people can use it in their own work, and they can use it to interpret those disclosures.
so is it like a percent or
No, it's a fixed amount of capital.
got it, got it. So okay, just so we understand what's how your overall allocation is like. So like you have a base of like 1,000 units and you're dividing them or like.
Well, the trouble is, and the reason I don't disclose its percentages is that I use a portfolio margin account for those 3 times ETFs, and so the available capital, particularly when you've got hedge positions, it
Fine.
varies according to how keen interactive brokers are for me to bankrupt myself, right? So at any given point in time, and right now at the moment, the available capital is something preposterous, which would be a great way to, bankrupt myself if I went that far. And at other times when the market's very bearish, the available capital is less. And so I never did. So there isn't a fixed amount of capital in that account, and that's why I never disclose it as percentages, because it doesn't make any sense to do so. Um,
Got it.
So I don't think in terms of percentage allocations. I think in terms of unit allocations. And what I do is I keep an eye on what's my overall capital exposure. What's the overall margin draw? How comfortable do I feel about that? Do I have enough, cash elsewhere that if I got myself into trouble, I could just redeem the whole thing and shut it down and walk away and do something else instead. As long as that is all in line, then I'm relaxed.
Got it. Got
If
it.
when I'll sometimes when you run these hedged accounts, you can sometimes end up with, quite large capital or margin exposures if you're holding long and short ETFs. And then I'm always keen to reduce that exposure as quickly as I can, just to keep things overall in life.
Got it. Got it.
But with an accordion type account like that, it doesn't really make any sense to say, what percentage exposure. That's why another reason I use units.
Oh, got it. So how do we interpret your numbers, right? Like when you say, okay, 1 unit or 5 units, like what is big, what is small, like in terms of like, if you have a strong conviction, is it going to be 10 units or just
Um,
yeah.
Well, just watch the disclosures. I mean, right now I've got. Uh, just hang on 1 second. I'll tell you. Hold on. Okay, so by current market value, uh, biggest position is TQQQ, which is about 32 units. UPRO about the same. TNA 26 units. Um, and then single stocks, much less. I mean, I'm always happy to take really big exposures with those 3 times ETFs because they can be hedged. So, if the market moves against me, whether I'm long or short, if the market moves against, I could just apply a hedge and suspend time while I work out what to do. Whereas in single stocks, it's much harder to do that. So, but in comparison, if I were to look at, just 1 second. Okay, if I were to look at single stock names, so I have, 3 units of Twilio, for instance, 3 units of Disney. I mean, I have much, much less exposure to single stock names because they're much harder to hedge. And the volatility in all some ways the volatility in any single stock is higher. In other ways, it's lower. But again, you can hedge the volatility in those 3 times ETFs. So, yeah,
Got it. Got it. Thank you.
welcome. Anyone else, folks? Okay. All right, let's move on. Let's do some earnings. So let's get this just on your screen right now. So the earnings we're going to cover today are those that are printed since the last webinar. I'm not going to cover those stocks that printed today. You've not had time to run through them, but we will roll them up in due course. So let's do Zscaler, Snow, Autodesk, Iridium, CrowdStrike, and Spire Global. Okay, so let's start with Zscaler. Let's get this on your screen. Okay, so we have Zscaler right here. Stock sold off a little bit since earnings. So it was a good quarter. They saw growth reduce again from 40% in the October quarter to 35% in the January quarter. They're guiding to 28% in the April quarter. TTM growth 41% plays 36% for the guide. Gross margin still good, 78 points. EBITDA margins moved up a point to 19. Cash flow margins dropped a point actually to 15%, and that was predominantly due to 2 reasons: a small increase in capex, but a fairly material swing in change in net working capital from very positive last quarter to a little bit negative this quarter. Balance sheet improved, $1.3 billion of net cash now. And then if we were to look at the deferred revenue remaining performance obligations, so deferred revenue, prepaid element of the order book, up to $1.5 billion now. and 35% growth in the prepaid element of the order book. Remaining performance obligation, that's a total order book, 29% growth, now stands at $3.6 billion. So it has about 1.9 times trailing revenue in forward order book, so plenty of revenue visibility. And all in all, the story continues to be a good one in my view. Stock sold off a touch. Let's see where it closed today. 1 second. Okay, 199 now. So valuation, this is an expensive high beta stock. So 15 times revenue, 96 times trading cash flow. That's that's an expensive stock. No two ways about it on fundamentals. Does it matter? I don't think so personally. I think this is about a long-term story in the technicals. So this is a weekly chart. The stock peaked at 260, now down to 201. This kind of drop is normal for high beta names. And so, you have to form a view as to whether you're happy to accept this kind of volatility. Volatility works two ways. It means benefit to the upside and risk to the downside when it happens. Personally, I like Zscaler. I believe it has a bright future, so I'm just holding at this point. I haven't sold any, haven't added any as a result of earnings or this drop. If we were to look at the shorter term chart on Zscaler, just get that up right here, then we posted this in Stock Central a few days ago, and I suggested that we might see an ABC correction of this nature. So here's the peak at 260, an A wave down right here, dropped to 201, B wave up here to 251, and if we get a sort of typical A equals C correction, then the price drop on the C wave would be equal to 260 minus 201, so call it $60. The top of the B wave was 250, so it might go down to 190, let's call it. So we might see a drop down to 190. So far down to 196, so there might be a little weakness yet to come. But after that, and that would correspond, by the way, to a 0.5 retracement wave 4 here. So that's a nice two pieces of evidence saying that we might see support somewhere in this area. Green for support. And if so, then we may see a wave 5 take the stock up to somewhere between 270 and 300. So I personally remain pretty bullish on Zscaler. I'm happy just to do nothing and let it play out. Okay, let's move on. Let's do Snowflake. Now, Snowflake, which I have to say I'm pretty skeptical on since its IPO, never much cared for the management team, all of whom were on their last hurrah prior to retirement. The CEO has now stepped back and upstairs into the chairman office. The quarter I thought was fine, right? So growth slowed a tiny bit. So if you looked at the growth last quarter, 31.8% in the October quarter, 31.5% in the January quarter. TTM dropped a bit from 41 to 36. Gross margin ticked up a bit. EBITDA ticked up a point from 7 to 6% on a TTM basis, and cash flow is stable at 16% on a TTM basis. Balance sheet's fantastic at Snowflake, $4.8 billion of net cash. So nothing bad's going to happen there for a very long time, if ever. And the thing that caught my eye was a nice step up in the order book. So the RPO growth was 41% this quarter, placed 23% last quarter. Now, this is the January quarter sometimes sees a step up. It did last year. So there's some seasonal effects in there, but nonetheless, 41% growth in order book is pretty good. The CEO announced he was retiring. He's a popular CEO. Never been a fan of him personally, but a popular CEO, and the stock got hit. Let's see where it closed today. So 167.59 now. Now the stock again will still be pretty expensive on fundamentals. Yes, 18 times revenue, 109 times cash flow. So you would never buy this thing because you thought it was cheap. But let's have a look at the chart. So here we have, this is the longer term chart since IPO. And the key thing to look at here is the volume by price charts. So the initial drop after earnings was to 185. And you can see why. It was the first of these high volume nodes. Okay. And so very often when you hit a high volume node, you can find support there because you have institutional buyers who will look to defend the price. That failed. And it's then dropped into this second high volume node. So it went down to a low of 163. It's since bounced a little bit. And again, 163 was $1 or $2 above this high volume node right here. So I think that Snow will find some support around here. If it dropped below 135, I'd be very surprised. That's been a well-defended low since May 2023. And I think that it can keep moving up thereafter. It could be wrong, obviously, but if we were to look at the short-term chart, Snowflake, hold on. There we go. You know, that to me looks like just a particularly volatile kind of wave 3 up. So I could be wrong. I think invalidation would probably be, well, I mean, definitely below 119, you would say it's broken. Below 138, probably broken. Below 128, it's a bit more probably broken. But my guess is it can keep moving up. I don't see a bad thing arising from a change in CEO, and I would expect the stock to pick up, but we shall see. Let's move on. So let's do CrowdStrike. So CrowdStrike, stock printed, it sold off into earnings in sympathy with Zscaler, shot up 20 points on earnings this week. And let's have a look at the quarter. Now, if you read our earnings report on this, it's important to read it, I think. There's nothing in the quarter's numbers that really, in my opinion, justify that 20% jump. Why I think the stock jumped is because, in essence, CrowdStrike and by association Zscaler and by association Cloudflare NET, it looks like they're gaining share from Palo Alto Networks and very specifically gaining share in the federal customer base. Now that's important if they are, because it means that federal clients are moving from bespoke hardware solutions. So if you buy Palo Alto Networks, you've got to buy one of their boxes and run services over it, to pure software that can be run on any server. That's a meaningful shift in cybersecurity, and it opens up sustained future growth opportunities to CrowdStrike, to Zscaler, to Cloudflare, and one or two others. SentinelOne will be other. And so I think that the stock spike, insofar as you can ever assign reason to it, is probably because of weakness from Palo Alto in federal and strength from CrowdStrike in federal. It suggests that they have more in network services than perhaps has been apparent. Anyway, so it's a really good print. Earnings were fine. 33% growth, placed 35 last quarter, so not much of a decline. 36 on a TTM basis, placed 40 last quarter. Gross margins holding at 75%, good. Sales and marketing is getting really efficient. Look at the improvement. So, April 23, sales and marketing spend was 41% of revenue. It's now 34, and yet growth is starting to bottom out and might accelerate soon. So that's good news. Return to G&A is also good. It's becoming less of a proportion of revenue, so starting to become a more efficient business. And you can see that in the EBITDA margins. So TTM EBITDA margins 25% nearly, plays 19 a year ago, so that's nice improvements. Cash flow margins also ticked up a bit to 19 points. So nothing dramatic there. It used to be a much higher margin business, CrowdStrike, so hopefully you can get up further from here. But nice to see a small improvement. Balance sheet, great, $2.8 billion of net cash, so no worries there. Deferred revenue growth ticked up a bit as well, from 26 up to 30%. That's nice to see. Deferred revenue growth, again, that's the prepaid element of the order book, worth 100% of trailing 12-month revenue now. So that's getting plenty of revenue visibility. Stock price, let's see where it closed today. 326. $25 times revenue, 130 times cash flow. So again, you're not going to buy this because you think it's cheap, but you might buy it because of the chart. So let's have a look. So this is, I think, if the market stays bullish, I believe this could hit 422. which is a 1.236 extension, wave 3, and maybe 525. That's a 1.618. Now, of course, it's not going to do that tomorrow. Any manner of things could go wrong, but this has been a wild ride, just a brilliant story. We called accumulate on this between 90 and 130, now at 329. So that's been a righteous call so far. That's crowd. Any questions, folks, before we move on and do the next single stock earnings? Let me just check our chat room 1 second. No. A comment from...
A quick question before
Yeah,
we
go.
end. So on Zscaler, right? So the concern on the street was on the billings.
Yeah.
So can you shed some light on what you think about that?
Yeah, I mean, I don't look at what anyone else calls billings. I look at remaining performance obligation, which is they sort of hover around the same things. The definition will be a bit different probably. RPO is the total order book, both prepaid and not prepaid, but it's orders that have been confirmed by clients. So let's have a look. The growth in the order book is 29%. Okay, so you have an order book of $3.6 billion, which is worth basically 2 times the last 12 months revenue. It's growing at 29%. Now, it was growing faster than that, but that doesn't give me any cause for concern. It doesn't. Growth is slowing, as growth will always slow in high growth businesses as they get older, because large numbers apply. You have to find more and more chunks of revenue to keep growing at the same percentage rate. So growth rates will always come down. But that order book performance doesn't give me any concern at all. Now, the backdrop for that for me is that I believe that Zscaler will continue to gain market share, and I believe it will continue to do so because it's much cheaper than using proprietary hardware like Palo Alto Networks or Fortinet or any number of other solutions. The company has all manner of FedRAMP approvals, services, all manner of high-end clients. And if you look at the breakdown, I can't remember the exact numbers, but they've got a very large number of customers paying them over $1 million a year, and a surprising number of customers paying them more than $10 million a year for a cybersecurity service. So I think this thing's got a bright future. I'm not stressed about this one.
Good. Thank you.
Welcome. Okay, let's do Autodesk. So this is stalwart of design software. So it's used to design buildings, products, some movie stuff apparently as well, which I was unaware. Rock solid business, and printed just a good quarter. Now I'd held this for some months, and I sold it in the morning right after earnings. I'll show you the chart as to why. But it's a good print. So 11% growth for the quarter, placed 10% previous quarter. TTM 10% versus 9%. Gross margins 91%, fantastic. Now look at margins here. EBITDA margins 36%, coming down from a high of 37%. That's okay, no stress there. But cash flow margins not very pretty. 30% cash flow margins in a business of this kind. That's not great. It peaked at 55 in April. That's sort of too high. But if you look at the long run average, it's in the mid to high 30s. And so a drop to 30% is concerning. Now that came about because if you look at the working capital performance in the last 3 quarters, it's been pretty negative. Whereas if you just go back all the way over time, it's usually positive. In other words, usually the company is getting paid faster than it is paying its suppliers. And so for all of the model history here, it's generated cash from working capital. That means over many years it's getting paid more upfront than it is paying out at that same time. But we've had 3 quarters now of working capital outflows. That's not a great look. Balance sheets good and improving. It's only just in net cash. It's got a $2.3 billion of debt, but I mean, with this level of cash flow, that's not a problem. Deferred revenue growth slowed. So it was negative 7% on the last quarter. and the RPO growth slowed from 12 down to 9. Now, if you look at the stock chart, this is why I sold. Very simple. So I had my eye on it, and I've made a note to sell at 284 or a bit below, because that was the 1.618 extension wave 3 there. So I had a note to say if it gets near to 284, sell. And on the earnings print, it spiked overnight, really close up to there. And then in the morning, and I hold this in an account that can't trade out of hours. It's a sleepy UK retirement account. In the morning, it opened strongly, but it was fading, and so I just sold. I think I sold it for 275. Now at 253, and it dropped to 246. I'm happy to be out of this for a while. It's a good business, but it's into this probable wave 4 down, and I'm happy. I forget my entry price, but I posted it in chat or whatever it was. I think I made about, I'm going to guess 30% gains. I can't quite remember. I posted in disclosures at the time. So I'm happy with the run there. It's a relatively sleepy business, and I'm happy to have banked decent gains, and so I'm out. We continue to rate the stock at hold, and the reason for that is because I think it can put in a wave 4 low and then make it a run into a wave 5 higher. We'll see, but that would be my best guess if the market holds. That's Autodesk. Let's do Iridium while we're at it. 1 second. I'm just going to switch off sharing and call up the screen. 1 second. Okay, so here we have Iridium. Let's do the chart first, actually. So we had a really nice run with this business. And we were bullish on it from around 2018, 2019, as they completed their latest round of satellite construction and launch. And then we called distribute on this between 60 and 68. And the reason we called it there was because that's the 61.8 to 78.6 Fibonacci extension of the prior wave 1 to 3 combined, which is our standard wave 5 termination zone. And look, perfect. Now, what I was saying earlier about you don't have to be twitchy about spotting tops is, look what happened here, right? This is a perfect example where it spiked up to the 78.6 extension at 68, and then it spent a lot of time hanging around that $60 level. And so that's distribution, that's institutions selling slowly. And so if you were concerned about holding Iridium, and I was at the time, then you would look at this and you would say, that's probably distribution. It's a key technical high, and you're seeing basically range-bound sideways action at high volume. That's selling, time to sell. So we call distribute there, 60 to 68 distribution zone. Stock is now at 28. So that was I'm pleased with that. It's a nice call on the way up, and it's a nice sell call as well. Now, where will it fall to? Well, technically $20 is the target. And the reason that's the target is because that's what an A, B, C correction would look like if we get anything like a reasonable C leg. It could be worse. We could see a C equals A go further. But that $20 also would be the 78.6 retrace of the whole move up from this 2018, 2019 low to the 2023 high. And if you remember, that's the sort of level at which Meta found support in 22. It's where NVIDIA found support. CRM actually fell a bit further down through that. So these sorts of drops are not at all uncommon. And so it's why it's good to measure where you are on the way up, so you know to take profits, and then measure where a big drop could come to, so you know when to think about buying. Now, Iridium, question for them, for the company, in my view, is does it have a viable growth story given all of the new LEO satellite constellations like Starlink, Project Kuiper, which is the Amazon equivalent? And my answer to that is I don't know. I know the company thinks that it has an answer. I'm due to talk to them in due course. Haven't done so yet. So we'll see how that plays out. But for me, I personally would be watching where the stock bottoms out. You would expect it to find support somewhere between the 61.8 and the 78.6 retrace. So just color that in green. That's your likely support zone right there, just purely on technical retracement. So for me, if the stock got close to 20, I'd probably think about maybe starting to build a position again. Probably, honestly, only if I got a clear sense from the company as to, what their strategy was and, why Starlink isn't going to erode their position further. That's Iridium. And then lastly, let's do Spire. Spire Global reported yesterday. This is a tiny, tiny, tiny business, as you know. $110 million $105 million of trailing revenue, so not big at all. It's one of the new space vendors. It's the best of the crop, in my opinion, on fundamentals. I've said that for a couple of years now. I stick to that. Company put in a reasonable quarter. They missed their guide a bit. As you saw from the stock reaction today, that didn't seem to matter so much. It sold off a bit this morning. It was down about 12% at one point, up again by the close. Let's go through the quarter. It's pretty good, 24% growth, 32% growth on a TTM basis. Gross margin held 60%. The big news was positive EBITDA in the quarter. That's not easy of a company at this size. So management teams to be congratulated for that, I would say. Cash flow is still negative. So negative $2.9 million of cash flow in the quarter. But I mean, that's a tiny loss compared to what they've been printing of late. And look at this change in net working capital, right? This is where the companies, you can see it's quite well managed. So over the model period going back to March 22, they've generated almost $3 million from working capital. In other words, they've been paid faster than they're getting paid out. Now, this is a tiny company. So to exercise that sort of leverage in your value chain, that's good going. It's going to be a while, I think, before they generate trailing 12-month positive cash flow, but we might see in the next 2 or 3 quarters positive cash flow for the quarter. Balance sheet isn't the prettiest. $74 million of net debt. A company this size with this cash flow profile really shouldn't have any debt, but that's a function of the funding environment at the time when they went public. And if we look at the valuation here, let's just update this for the closing stock price. 1 second. So it closed at 1362, so quite the jump on the day. Okay, so the company raised some equity a couple of weeks ago. And so we need to look at what does the balance sheet look like at the 31st of December when it was printed, and what does it look like today? So on the left here, this column tells you what the valuation of the balance sheet looks like, taking today's share price with the 31st of December balance sheet. And the answer is enterprise value about $370 million, so tiny. Trading 12-month revenue, $106 million, 3.5 times trading revenue. Net debt, 73.5. After the fundraise, so they raised $10 million at $12 a share. So you've got increased effective share count by about 0.8 million shares. You have a decreased amount of net debt because there's more cash on the balance sheet. And so the valuation nets out to be pretty similar. 13.62 a share gets you 370 enterprise value, about 3.5 times trading revenue net of the fundraise. So fundraise was a very smart move. It did 2 things. 1, bring some money in. That's good news. 2, raise that money at a premium. And 3, signal to the market that somebody was prepared to write a big check at a premium price. So, congratulations to them. Stock chart, I don't think you can really do technical analysis on stocks like this. I think with these tiny micro caps, you either like them and you own them, or you don't and you don't. And if you do own them, it's wise to keep a very close eye on your allocation, because stocks like this can go to zero. I'm not saying Spire is going to go to zero tomorrow, but stocks of this size in general, all manner of bad things can happen. Balance sheets can evaporate, delistings can happen, all kinds of things. And I'm not saying that those risks apply to Spire tomorrow. I'm saying for companies of this size, it's risky in the extreme to put big amounts of allocation towards them. Technical analysis is difficult because these things are not liquid. Very, very roughly, we have this at hold over $12 and at accumulate between about $2 and $12, and that's defined purely by these volume nodes here. I believe the company has a bright future. Happy to hold a position in it. I think the management team are going to keep improving those fundamentals, and I think at some point, institutions are going to start to notice the company as it gets in their scale. I believe the company will refinance the balance sheet with a more conventional debt package when they can. That's not going to happen tomorrow. So all in all, I'm bullish, but it's a small cap, or micro cap really. So you have to be suitably careful. Okay, that's pretty much what I wanted to cover today. So any questions, points, anything at all, folks, before we finish up? Steve, you're on.
Hey, Alex. Yeah, I had to look up when you were going over the fundamentals, unlevered free cash flow versus basic free cash flow. I was wondering if you could explain why you use, and I didn't know this, I just Googled it, why you use unlevered free cash flow.
Force of habit.
Okay.
So let's call up CrowdStrike. Okay. So a couple of reasons. One, this measures something very specific. Okay, unlevered pre-tax free cash flow measures a real thing, which is let's ignore the capital structure of a business. So let's forget whether it's capitalized with equity, debt, convertible loans, non-fungible tokens. Who cares what the capital structure looks like? Let's look at the money that the actual business produces before it has to service debt, pay dividends, pay the IRS. What money, cash money, does the business, does the operation spit out after capex, after changing working capital? And that's what unlevered pre-tax free cash flow measures. So it is the purest measure of business quality cash flow that I can think of. And one of the reasons we use it is because we want a standard measure to be used across all the different companies we cover. So whether it's a highly leveraged defense prime like Raytheon, or a super cash rich business like Microsoft, or a tiny micro cap like Spire, we want the standard measure so that we can compare company with company with company, and we don't have to sweat about what's the capital structure. Where we capture net cash generation after everything is in the net debt measure. Okay, so the net debt each quarter, to state the obvious, is net of anything they've had to pay the IRS that quarter, any dividends they've paid that quarter, any share buybacks they've paid for that quarter, any cash interest costs, any debt principal repayments. It's captured there. And so unlevered pre-tax free cash flow, think of it as a measure of how good of a business is it, right? How much cash is the business churning out? And then the net debt number captures the what is the impact of the capital structure on the cash generation, basically. That's
not to put words in your mouth, but would net debt be kind of sort of equivalent to just your regular FCF, free cash flow?
No, net debt's the balance sheet. No, net
Okay.
debt is the balance sheet. Okay, so net debt is very simple. You take cash and equivalents, add short-term liquid investments, add long-term liquid investments. Okay, that's basically your good pile of stuff. And then you take to work out the debt, take short-term debt and add that to long-term debt. That's your bad pile of stuff. Take the good pile of stuff away from the bad pile of stuff, and that gives you net debt. So if you've got a negative net debt number in our spreadsheets, that's net cash. Positive net debt number, that's net debt. And the reason to do it like that is because, again, we can use the same measure whether we're looking at, again, highly levered, highly indebted business like a Defense Prime or Lockheed Martin or whatever, or a highly cash-rich business like an NVIDIA. But no, net debt is balance sheet. That's a snapshot of the bank account, for want of a better term, of the business at that time. The change in net debt each quarter, okay, tells you what's the absolute change in the cash position, if you like, of the company from quarter to quarter. And again, that will be net of cash tax payments, cash dividend payments, cash debt service payments, cash principal redemptions on debts, share buybacks. Any use of cash will be captured in the change in net debt from quarter to quarter. Okay. Folks, but people don't ask about this stuff, and you really should. It's not necessarily obvious, and you have to remember that I have many years clocked up in leverage buyouts where you are very focused on changing net working capital. You're very focused on leverage, and I have many years in venture capital where you're very focused on liquid cash availability. So this stuff is second nature to me. It's not analyzed like this in many stock services. We're good at many things and bad at other things. I would say we're pretty sharp on this. I don't know anyone that does this better, really. I'm sure there are some, but I haven't found them. And so always ask about this. This is super high grade institutional quality fundamental analysis. And if you don't understand it, ask, because it's not difficult once you get into the weeds, but you just need to work through it and conceptualize it in your own mind. Then you can use it in your own work to good effect. Any more questions, folks?
Alex,
no. Okay. Press that. Hi.
On Twilio and Datadog. I think Twilio had a investor call last week, right? So and the stock has appreciated, I think like 6 or 7% since then. So just can you talk a little bit about Twilio and both of those scripts? Thanks.
Yeah. So the thing I saw on Twilio is they basically said, I mean, it was a good investor presentation actually. I think I posted a link to it in the chat. It was a good presentation. I liked it. It was detailed, thorough. If you cut through it, basically what they said was the Segment acquisition was a dog. They didn't say these words, but in effect, they shouldn't have bought Segment, and if they did, they shouldn't have paid anything like for it what they paid for it, which is no surprise. It also says, that presentation, basically we couldn't sell it for any price that we wanted to sell it at, and so we're going to restructure it. Now that is what it is. I liked the investor presentation. I think they're going about the restructuring well. I've said this before. I think that Twilio has a bright future. I do not think it's ever going to recapture its all-time highs. Not for 1 minute do I think that, but I do think the stock can move up nicely. And if we let's just 1 second while I'm going to switch sharing off while I find the fundamentals. 1 second. Sorry, won't be a second. Okay, here we go. Okay, so here's Twilio fundamentals. Let's just zoom in a bit. So the key thing with Twilio is the cash flow margins, okay? And we talked about this, I think, last week, but this is what's going on at Twilio. There's a heavy restructuring going on. So they're firing a lot of people, they're closing a lot of facilities, they're cutting a lot of cost, and that means there's a lot of one-time costs they're incurring. It means they're writing checks to people to go away, writing checks to terminate office leases, all those sorts of things, and that's expensive. The restructuring costs, they record an impairment charges, which is basically where you take a write down for assets that you bought that are no longer as valuable as you think. So there'll probably be another one coming, by the way, for Segment. Up here, so last quarter, $25 million of restructuring and $286 million of impairment charges. Now, all that tells you is, well, the company's made a lot of mistakes in the past. They spent lots of money that they shouldn't have done. No surprise there. When they report operating income, it's net of those restructuring impairment charges. So operating income this quarter, December quarter, was $362 million negative. Ouch, right? But it is reasonable to add these one-time costs back because they're not going to recur. So if you look at EBITDA, where we take operating income, add back depreciation, amortization, add back stock-based comp, because these are non-cash things. EBITDA, you're looking for some sort of cash proxy of accounting profit. We get to trailing 12 months EBITDA of $84 million, so positive. And then if we add back the impairment and restructuring costs, we get to $181 million this quarter and $570 million on a TTM basis. So we've got a 14% TTM EBITDA margin business here. That's pretty good. Look at cash flow, again on the same basis. It's cash negative, net of all the restructuring, but it's cash positive if you add back all those restructurings. So the story here is of heavy restructuring, but that is working. And again, I would look at that investor presentation if you hold Twilio or you're interested in doing so, because it's a really grown up presentation. It's not, you know, the garbage you often see where a management team will say everything's going to be fine. It's a really good presentation. And I think that Twilio can work its way out. So $60 right now, you know, I think it can go higher. I don't think it's going to go back to the, what did it peak at? And it's going to go back to 458 anytime soon. But I do think it can make good progress from here. That's my view anyway.
So, just like in terms of their technology and all that, right? Like they're still in kind of this. Their technology once was premium, and now like a lot of cheaper companies have started. A lot of smaller companies have started offering their services for free, right? And then charging for services on top of what they provide, right? So basically, Twilio is kind of pricier, and their services is a little more basic than what others are offering, right? So do you happen to know if they're working on like basically things that can move the revenue up?
I don't know. I mean, I suspect you may know more than me on that. I don't know. I just look at the fundamentals and the charts and an overall take on the technology. In general, if you're using a piece of software like this and you're an enterprise customer, you probably don't want to use small companies for this stuff because it's too mission critical. It's not worth it going wrong, and any cost savings you might get hold of are probably not transformative. So, I mean, it wouldn't surprise me if it is being eaten away at by open source on the low end. Um, some major cloud providers on the top end, but I don't know. Just my instinct is it can keep going. I mean, growth's obviously down a lot from, look, 41% in June 22 down to 5% in December 23. So growth is down a lot. I have a feeling that it will work out, and I suspect, as I said before, the company will get bought. So I do not expect this suddenly to rise phoenix-like from the flames and suddenly become a wonder stock again. I don't think growth will be at 50% ever probably, but I think it can turn up from here. So I don't. I have a small allocation of this thing. I don't think it's a moonshot, but I do think the stock can keep climbing up. My opinion, anyway.
And how does the short-term chart look like for the script?
Good question. So well, not desperately clear, but if I had to guess, I would say I'd probably call that a sort of start point, which is the May 23 low. Because the low in 22 to the low in 23 kind of went nowhere, didn't really make any progress. So I think I'd probably call that a zero. A 1. That's a nice wave 2, right? 78.6 retrace. That's not a big enough wave 3 high. Let's stick a wave 3 up there for a minute. So let's just measure this and see what it looks like. So, I mean, yeah, theoretically that's a wave 3 high. It's a 100% extension, bit more. So that technically is possible. I don't know. Could that run to, well, could it run to 82? Yeah, I think it probably could in time. 92, that 92 feels like a lot, right? So if it got to 92, I think I'd be happily selling. 82, 1.236 extension, I think it might be able to get there, yeah. The trouble with these sorts of stocks is, this chart method works best. The more liquid the stock, the better this chart system works. So these charts work just great. This method works great on index stocks, on index ETFs. I'm sorry, on big stocks like Microsoft and Apple works really well. And the smaller and weirder a stock you get to, they don't really work. So I wouldn't try to chart Spire like this, for instance. And even at Twilio scale, which what's it worth now? A couple of $1 billion. $7.5 billion. Even at that scale, there's not really enough trading volume for these charts to work brilliantly. So if I'm honest, it's a bit hesitant to lean on Elliott Wave for these things. But if I was going to lean on it, I would say I'd be reasonably confident of 82 in time. I'd think 92 was, if I got 92 personally, I would jump for joy and sell and run away. Would be what I would do anyway.
Got it.
All right, folks, we're out of time. So thanks everyone for joining us. As always, we'll post a video in a couple of hours. Any further questions you have, feel free to get in touch in any of the usual ways. Comments to YouTube, chat comments in the Seeking Alpha chat room, or any other way you care to reach us. Thanks, everyone. Talk to you all soon.
Thank you, Alex.
You're welcome.